Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Alphabet has one of the most impressive products in the technology world today and in business in general, with search and then all the adjacent products that go along with it, including products like YouTube, where you're watching this right now. But I think the question for investors right now is, should Alphabet start paying a dividend? And I think the answer is yes. They have plenty of cash on the balance sheet. Business continues to grow, continues to churn out more cash. And at some point, you have to return that cash to shareholders. You really have two options. You can buy back shares, something the company is doing right now, and you can pay out a dividend. Given the size of the company, the maturity of the company, I think it's time to start paying that dividend. So I want to dig into that today. My name is Travis William. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And if you enjoy this video, check out my newsletter, Asymmetric Investing, in the show notes. Got a lot of great content there. And I want to start with this chart. There's a lot of information here, but I'll leave it up for a second. This shows the cash from operations and free cash flow in the top section. You can see that nearly $1 billion in cash from operations over the past year. Free cash flow, $71 billion. So like I said, Alphabet is generating a ton of cash. At the same time, this green line, cash and short-term investments, now stands at $118 billion. There's really no reason that a company generating $100 billion a year in cash needs to have $100 billion in cash just sitting on the balance sheet. So you might as well do something with it. You can see that there on the bottom, we are starting to see Alphabet buy back shares. Over 1 million shares bought back in the last 3 or 4 years. So this is something that management is obviously looking at. But I think there is the ability to now implement a dividend. Taking $50 billion of that cash generated each year and paying out in a dividend would be about a 3% dividend yield. Now, that's pretty high for a company starting a dividend. Usually you would see a company start with maybe 1% or even less than 1%. That's what Apple did when it started implementing a dividend. And Apple shareholders have really been rewarded in the meantime. Apple not only pays a growing dividend, but has also been buying back shares. I think that's a blueprint that Alphabet can copy. Start out with a dividend yield of maybe 1% and continue buying back shares. Given the strength in the business, the way that revenue and cash flow is growing, particularly over the last 10 years, I think that is a prudent thing for the company to do. And there's still plenty of money on the balance sheet to go out and make acquisitions or hire new talent or get into new businesses. When you have $100 billion coming in per year and $100 billion or more sitting on the balance sheet, there's a lot of flexibility in the business. Right now, we need to start seeing Alphabet start paying back investors. I think long-term, management should really target being in that 3, 4, 5% dividend yield range if the stock doesn't go anywhere, because it's something that they can actually afford to do. But right now, the only move is buying back stock. So let's see how this plays out. The founders are still clearly in control as far as shareholders go. So what they want to do definitely goes. But what would you like to see from Alphabet? Would you like to see a dividend? Would you like to just see them buy back stock? It doesn't seem like any big acquisitions, like a $100 billion acquisition, is probably going to be in the cards. So they've got to do something with the cash, and that's those two options. So which one would you prefer? I'd love to hear your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing, everybody. Thanks for watching. See you here next time.